So those are all the questions about that. Let me just flick quickly through a more general look at some of the other economic issues I think we've got. What are the bigger picture? There is a world out there beyond the autumn statement. Let me just give you a quick overview of some of the things I see. We've got a lot of issues around at the moment, a lot of economic challenges, particularly out there in the global economy. And if we look at what's happened since that recession of 2008-9, if we had been gathering here, as James and I did at another venue, where, after the budget, things at that time, certainly globally, were looking pretty good. That we'd had the recession in 2009, worst one in the post-war period, but the bounce back was very strong. So after the worst global recession in the post-war period, we saw growth of over 5% in 2010, and that was only one of 3 years in the past 30 where the global economy has grown by more than 5%. So strong bounce back for the world economy. Say a few months ago, things looked set pretty fair, and of course, the emerging economies are the new locomotives of this global upturn. You don't have to go back that far for a time when, if you go back to the 1990s, then 2/3 of global growth came from the darker blue ones here, the OECD countries, the advanced countries. 1/3 came from the emerging countries. Now it's the other way around, and for the foreseeable future, it's going to be the other way around. So the Chinas, the Indias, the Brazils, Indonesias, large parts of Africa, Latin America, they are the drivers of the global economy. And even though things have slowed more recently, they still are. World trade, again, had bounced back very strongly, fell by 10% in 2009, grew by 13%, very strong growth in 2010. However, more recently, we've seen things certainly turn down, certainly become more doubtful about in terms of the global recovery. The stock market, this is just the FTSE, it doesn't always reflect what's going on in terms of economic growth, but this time I think it did. So, the low point for the FTSE, as you'll know, was March 2009. And we get, at that point, people thought that every bank in the world was going to have to be nationalised, and that we're heading into a new Great Depression. And maybe that view will come back again, I don't know. But then you see the market recover quite strongly as the economic news gets better. The recession in 2009 is concentrated in the first half. It's from the middle of the year things start to pick up, so the economic news gets better, and so does the company news. So the market is lifted by that. Very strong rally in the shares. Has a dip when we start to see the first inklings of the euro crisis. That's the Greek rescue there in May 2010, but resumes its rise and remains quite high until you get into the sort of late spring and early summer. You remember August, a time of huge turbulence in the stock market, and that's when the doubts start to creep in. And this is one way of measuring global economic activity. These are called purchasing managers indices. They're the easiest economic indices to understand because when they're above 50, they tell you there's growth. When they're below 50, you're in recession. And you can see, the recession, you can see the bounce, but you can see also more recently, and particularly for manufacturing, how things have weakened on a global basis. And that's particularly true in the advanced economies. So it's true in Western Europe, North America, and of course here in the UK, and even that big bounce in world trade seems to have stalled in the last few months. World trade was growing very strongly, seems to have plateaued a bit in recent months. So why has this happened? Well, there are short-term and long-term factors here. The first thing, which I think has had a big impact on manufacturing, had a big impact obviously on the Japanese economy, was this, the terrible earthquake and tsunami that we saw back in March. And that didn't just affect Japan, of course. It affected global supply chains. It affected manufacturing here in the UK, all around the world. It affected manufacturing in China. But that was clearly a very tragic but temporary factor. This, I think, has been more important. I mean, if you look at the report of the Office of Budget Responsibility yesterday, they say that the big factor explaining why growth has been so disappointing over the last year has been unanticipated high inflation. So, inflation largely coming from this commodity price boom, and you can see how powerful in comparison with the past the commodity price boom has been. Commodity prices fell very sharply when the crisis hit, but resumed their rise quite quickly. And that has meant something rather unusual, that, and for the authorities rather unexpected. Most times after a recession, you expect inflation to be very subdued. So throughout the 1990s, inflation was extremely subdued. The oil price fell during the 1990s. It went to $10 a barrel in 1998. This time, almost as soon as growth got going globally, so did commodity prices. And that is because it is led by these emerging economies, which are more commodity hungry, and it's given us a more inflation-rich recovery than would be the norm. Normally, as I say, it's the spare capacity left over by the crisis that gives you very low inflation. This time it has been different, and this time it has been quite painful. And that's probably, as I say, in the case of the UK, the biggest factor explaining why growth has been subdued. We've had unsettling developments like the downgrade of the US in August. Much talked about, but when it happened was still a shock, and unsettled people at a time when they were already unsettled by other things. Fears of did we really get through it in 2008-9, or is the banking crisis coming back again? You will get different views on this. I mean, my general sense is that UK banks, US banks probably did enough, under some pressure, to strengthen themselves after the crisis, after the worst phase of the crisis in the autumn of 2008. But there was still a lot of work, and still is a lot of work to do in Europe. So that is where the pressure is. And we know, from the crisis 3 years ago, that if one bank is weak, then that leads to problems for other banks. So the contagion risks are there, even if in an individual country you've taken steps to strengthen your own banks. But most of all, of course, we've got the Eurozone crisis, and this is as I say, this is the thing which has the potential for making any forecast look ridiculous. For on the one side, you've got the prospect of whatever the OBR or the Bank of England or the OECD expects to happen to growth, and in general that picture is flat for the next few months, followed by a pickup, but with the risk of a very substantial accident emerging from some sort of disorderly breakup of the Eurozone. And this is a very difficult thing to judge. I mean, if you look at this, even relatively recently, so 2009, 2010, in the case of somewhere like Greece, the Greek government had already by then, the new Greek government had already by then owned up to the fact that all their public finance numbers were fantasy. It was one of those classic things of a government taking over, looking at the books, and normally it happens here to a minor extent. Things are much worse than we thought. There it was huge and substantial. Every number is wrong. And then, but even after that, people thought, well, how bad can it be? Until the spring of 2010, the Eurozone was still working as it should have been working. As people thought it would work, which is essentially that countries like Greece paid the same kind of interest rates on their government bonds as Germany. There's a premium, obviously, because Greece is inherently more risky than Germany, but not a huge one. So Greece could get away with paying 5% on its government bonds. And then you get the breakdown. Then you get people starting to question not just their fiscal numbers, not just their budgetary numbers, but the whole ability of the Eurozone to survive. And then, you get interest rates going to ridiculous levels, which was never supposed to happen within the Eurozone. I mean, you've had recently, on some days, Greek interest rates of 90% or something like that. So, so this has been a breakdown in the fundamental purpose and structure of the Eurozone. We've seen one of those neighbours now go and been replaced by the new technocratic government. But you've got within that, reasonably summed up the three different views you've got of how the Eurozone should get through its crisis. The Italian view would be that we're essentially in reasonably healthy shape. We just need you to help us out. The French view is that certainly more should be done centrally, and if we can move towards a fiscal union very quickly, then that would be the best way out. And the German view seems to be to say no to everything. So it's so there are those three different views there. And the great risk is that this just spreads, So before and even after the Italian election, sorry, not the election, they haven't had an election. The Italian coup, I should call it, perhaps. The replacement of Silvio Berlusconi by the new government, which doesn't include any politicians, which is interesting. And even after that, you've had these very high Italian bond yields. So the crisis is still going on there. And in answer to James's point earlier, I mean, it seems to me, and it is a puzzle about the exchange rate. I mean, why is sterling not stronger against the euro than it is? And I've always maintained that the fair value for euro sterling is of the order of 130, 135. We're stuck at about 116. We have been lower than that, and part of the reason for that is that anything that happens in Europe is always trumped by the Bank of England being prepared to be even more dovish than anything that the European Central Bank can do. So it seems to be whenever sterling has been due to have a decent recovery, the Bank of England has either said we're going to print more money or we'll keep interest rates low for even longer. So plus, of course, it would be wrong to say there are no concerns out there about UK public finances. So we are not, we're not separated. But it's almost as though, the bond markets think that Greece represents the euro, so they're very worried. And the currency markets think that Germany represents the euro, so they think it's still quite a strong basic currency. So I'm sure, and people in this room will have ways of doing it. I'm sure, or can think about ways of doing it. I'm sure there are wonderful arbitrage opportunities there, but I can't quite think of them. But there is it is odd. It's puzzling, and of course Spain as well is part of it. Spain did have an election and has got a new government, but this crisis is the big concern. It does. I mean, we can debate about whether, on present trends, Britain will or will not have a technical double dip. It seems fairly clear that the Eurozone, as a result of all this, is going into some sort of recession. It need not be a big recession, although, some member countries, such as Greece, are in the middle of big recessions. Others, which have had help, are coming out reasonably well. Ireland is doing okay at the moment. But overall, the prospects don't look great for the Eurozone. How do we get out of this? I mean, this is the plan that they're still working towards. That you have to do to the Eurozone banks what you did to our banks in 2008-9. You try and increase the firepower of this rescue fund, the Financial Stability Facility. You increase the amount that the private sector owners of Greek debt will lose. But you say, well, that's an exception. And it's quite interesting that other countries that were rescued have not called for the kind of default, effective default, 50% haircuts that Greece has done. So this was the plan. And unfortunately, as with many things Europe, which involve, in this case, 17 different political leaders, it's taking a lot longer to put it into place than was hoped. Long term, I think you've got all sorts of possibilities. Obviously this one is the strategy at the moment, muddling through. But on one side, you've got, the idea that you could move towards fiscal union, being resisted by, quite a lot of people, and most importantly Germany at the moment. But that would, fiscal union is effectively, losing control of your public finances, you're losing control of your tax and spending. But it would work, I think. I mean, if the political objections can be overcome, then the fact is that overall Europe has healthier public finances than Britain or America. So if you're able to combine the relative health of the public finances of countries like Germany, Austria, the Netherlands, with the in general the problems in smaller countries. In Italy's public finances, to be fair, are not as bad as they're often painted. It has high debt, but doesn't have an enormous budget deficit. You could probably handle it, but there's a lot of politics in a move towards fiscal union, and then you've got various options for the euro not continuing as it is. Now, my view on this is that the euro will not will survive as a currency, but not with all its members intact. So I think we will see some countries leave, but the hope has to be that can be done in a reasonably orderly way.